Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at brand engagement network.
If you find our talks useful, please consider subscribe, like, and comment underneath. Now, if you follow the broader tech space, you know AI is literally dominating the conversation.
Oh, it's everywhere. Every single day.
Right. There's a new headline about some massive general knowledge chatbot that can write your emails or code a website. But today, we're looking at something completely different.
Exactly. We're looking at a microcap company that is basically building the exact opposite of that open source model.
Yeah, a walled garden. Specifically for highly regulated industries, we are talking about sectors where a single data leak wouldn't just be an IT headache, it would be catastrophic.
It would be a business-ending event. And it's an incredibly timely subject for your portfolio right now. To really grasp why we are looking at brand engagement network today, we have to look at the calendar.
The timing is huge here.
It is. Today is March 4th, 2026. And in the tech sector, timing is everything. This company has some major, potentially transformative catalysts coming up this exact month.
So for anyone tracking the evolution of enterprise AI or looking for wealth-building opportunities in the microcap space, we are in a very sensitive window.
Very.
I am really glad you brought up the timeline, but before we get to the upcoming events, I want to establish the actual foundation here because, every company claims to be an AR company right now.
Just adding it to their pitch deck.
Exactly. But Brand Engagement Network centers its tech on something they call the engagement language model, which features retrieval-augmented generation.
That is a very heavy string of jargon.
It is. Can we break down what that actually means for a business? What is the practical application?
That's the perfect place to start. Let's contrast it with the big generalist models everyone is used to. A standard large language model is trained on the open internet. Think of it like a brilliant, overconfident intern who has read every book in the library. They know a lot, but if you ask them a question, they might just guess the answer based on a fuzzy memory.
Which, in AI, we call a hallucination.
Exactly. And furthermore, if you tell that intern a highly classified company's secret, they might accidentally blurt it out to the next person who asks a related question.
That sounds like a complete privacy nightmare. I wouldn't want an AI guessing when it comes to my medical records.
Nobody would. And this is where retrieval augmented generation comes in, RG for short. Instead of the AI trying to answer questions from its vast, fuzzy memory, RG is like giving the AI an open book test.
Okay, I like that analogy.
But, and this is the critical part for investors to understand, the only book it is allowed to look at is the company's highly secure, internally approved database.
So it's fenced in.
Fenced in completely. The engagement language model is a closed-loop system. It retrieves the specific fact from the secure vault and then generates the answer. It doesn't guess, and it doesn't pull from the open internet.
And it's multimodal, right? Meaning it handles voice, text, even avatars.
Correct. It can be a lifelike avatar speaking to you, entirely contained within that secure ecosystem.
Looking at the broader regulatory landscape, I imagine that closed-loop design isn't just a neat feature. We are living in an alphabet soup of data privacy laws. You've got GDPR in Europe, HIPAA for healthcare in the US, SOC 2 Type 1 security frameworks.
It is a massive hurdle for enterprises.
So how much of an advantage does this walled garden give them when trying to sell software to, say, a huge hospital network?
It's the dividing line between getting a meeting and getting the door slammed in your face. In high stakes, niches, life sciences, hospitality, finance, data security trumps raw computing power every single time.
Because the fines are astronomical.
Exactly. A pharmaceutical brand doesn't care if an AI can write a creative poem. They care that the system will never, under any circumstances, expose patient data to an external server. That verifiable compliance is a massive competitive moat. The big, open-source AI players simply cannot guarantee that level of containment without rebuilding from scratch.
And speaking of moats, I was looking at their intellectual property. They are aggressively trying to deepen it. They hold 21 issued patents with another 28 pending.
Which is a huge number for a microcap.
It really is. Now, in software, patents can sometimes be defensive fluff. But in this specific compliant AI space, do those numbers translate to a tangible wealth-building advantage?
They absolutely do. Think about the barriers to entry. If a startup wants to compete in secure, multimodal enterprise AI, they have to navigate a minefield of patents held by Brand Engagement Network.
So it keeps competitors at bay.
Yes, but the bigger advantage is the switching cost. Once a massive hospital integrates a fully compliant, patented AI system customized to their internal data, the operational roots run deep.
Right, you don't just rip out the digital brain of your compliance department to save a few bucks a month with a competitor. It's way too risky.
Exactly. The stickiness of this product is incredibly high.
That makes perfect sense on paper. But theoretical tech only goes so far when we're analyzing a stock. Have they actually convinced anyone to use this in a live environment?
They have, and the recent updates are quite revealing. One fascinating example is in hospitality. They deployed an AI concierge at the ultra-exclusive Seven Visions Resort and the Droven.
A luxury resort. Interesting.
And the major catalyst here is that it has officially moved out of internal beta testing and into live guest use.
Why is that shift to live guest use such a critical milestone? Couldn't they just keep testing it with staff?
It comes down to the quality of the data. In AI development, real-world operational data, specifically human-in-the-loop data, is the ultimate bottleneck. Employees know how the system works. They ask predictable questions.
They use the right keywords.
Exactly. But when actual luxury resort guests interact with this AI using their natural voices, they ask complex, unscripted, sometimes bizarre questions. Processing that unpredictable human behavior generates invaluable data.
It proves the tech works in the wild.
Yes. At scale, in a high-stakes customer service environment where the margin for error is essentially zero.
Okay, hospitality is one thing. But let's look at a space where the legal stakes are even higher. They recently locked in a vendor services project with a global ad agency specifically for a top 10 pharmaceutical client. That feels like a much heavier lift.
It is a significantly heavier lift, and it's where the real recurring revenue potential lies. This isn't just a conceptual partnership. They are operating under two distinct statements of work.
Meaning real cash flow.
Immediate development revenue, yes, but the true holy grail for any software company, and what you as an investor want to see, is what happens after the system is built.
The recurring revenue model.
Precisely. They are getting paid to construct this highly secure AI for the pharma giant. Once it goes live, they lock in recurring license and maintenance fees. Pharmaceutical companies have incredibly deep pockets and the highest compliance burdens on the planet.
So if they deliver here, it's a flagship case study.
They can take that success story to every other healthcare company in the Fortune 500.
Let's ground this in reality by looking at their financial health. Because building specialized AI is incredibly expensive. They have a market cap of roughly $208 million.
Right, a classic microcap profile.
With about 5.83 million shares outstanding. For an early-stage tech company, how do they fund this massive vision without running out of runway?
Liquidity is the existential question for microcap. You have to monitor cash burn meticulously. Recently, they've taken deliberate steps to bolster their balance sheet. For instance, they brought in $1.46 million in cash from warrant exercises.
Let's pause there for a second. When we say they brought in cash from warrant exercises, what does that signal to a stock analyst?
A warrant gives an investor the right to buy stock at a specific price before a certain date. When those are exercised, investors are handing actual cash to the company for shares. In the microcap space, this is often a strong signal of insider and early backer alignment.
So the people closest to the company believe in the near-term trajectory enough to put their own money on the line.
Exactly. They also completed a debt conversion of about $737,000. That essentially swaps debt obligations for equity, making their balance sheet look significantly less burdened.
But they are still raising money. I noticed they have ongoing private placements. There's a Tranche 3 closing coming up on March 25, 2026, pulling in around $506,000 for 8,000 shares at $63.25 a share.
Correct.
Raising $500,000 at a time feels like a slow drip. Is it a red flag that they keep going back to the well?
It's a calculated strategy. Whether it's a red flag depends entirely on capital allocation. If a pre-profit company raises cash for executive bonuses, run the other way. But filings indicate these proceeds are aggressively reinvested into R&D.
Pushing the engagement language model forward.
Exactly. In an AI arms race, reinvesting every available dollar into proprietary tech is exactly what you want to see. They are buying runway to reach the point where those pharma and hospitality revenues sustain the business.
I have to push back a bit, though. We are painting an optimistic picture, but the stock chart is chaotic. We are talking extreme volatility, massive rallies followed by sharp pre-market declines and severe dips. If the tech is so solid, why is the stock bouncing around like a ping pong ball?
It's a very fair critique.
Yeah.
And it is the reality of trading AI microcaps right now. This volatility is heavily driven by retail trading and options flow.
Just chasing the hype.
Right. A microcap company has AI in its profile. It attracts day traders. They write a press release creating a massive rally.
Hmm.
But because the company doesn't yet have the sustained revenue to justify a massive institutional valuation, those traders take profits and the stock consolidates rapidly.
So the noise is drowning out the fundamentals.
Completely. And what's genuinely fascinating is how financial media reacts. If you look at the quantitative sentiment scores across recent news stories for Brand Engagement Network, the score is literally 0.
Perfectly neutral.
Yes.
That seems impossible with such wild price swings. You'd think the coverage would be wildly bullish or deeply bearish.
You would think so, but the coverage is mostly sterile reporting on daily stock movements and factual updates on the resort deployment. There isn't a strong directional bias. Plus, they're flying under the institutional radar. They are currently covered by only one analyst at Maxim Group.
So a quiet consensus masking a very loud stock chart.
Exactly.
Let's look at this critically. The bear case practically writes itself. Extreme volatility, neutral sentiment, limited current revenue scale, and persistent dilution risk from those private placements. If the AI concierge glitches or the pharma project hits a snag, isn't there a serious risk of the bottom falling out?
Execution risk is absolutely real. If they fail to deliver on these enterprise projects, the narrative collapses. And dilution is a tangible risk. If they don't reach profitability soon, they have to keep issuing shares.
Which hurts current shareholders.
It does. However, at a $200 million valuation, a significant amount of that early-stage execution risk is already priced into the stock. The market knows they are pre-profit. The question is whether they can execute fast enough to outpace the dilution.
Which brings us to the calendar. Why March 2026 is the focal point? We mentioned the private placement closing on March 25th, but the massive date is March 30th, 2026.
Their upcoming earnings report.
Right. For a company at this stage, what makes this specific earnings report a potential turning point?
This is the moment the narrative has to translate into math. Up until now, the story has been proof of concept, patents, and beta testing. On March 30th, we might see the initial financial data from these deployments.
The first real revenue ramps from the pharma project?
Yes, and clarity on revenue recognition from the AI concierge. It's the transition from a great idea to a functioning business model.
And the macro environment is setting the stage perfectly, isn't it?
It really is. We are seeing a massive rotation in the broader tech sector. The initial hype phase where everyone was amazed a computer could talk is over.
Now we are in the implementation phase.
Exactly. Corporations realize they cannot plug generic, open-source models into their sensitive databases because the regulatory fines would bankrupt them. Demand is aggressively shifting toward compliant, enterprise-grade AI.
Plus, the potential for interest rate cuts, which historically provides a huge tailwind for growth tech stocks.
The timing is incredibly potent.
So, synthesizing everything we've unpacked today, the proprietary tech, real-world deployments in high-margin sectors, the volatile financials, and this tight cluster of March catalysts. What is the final thesis for the listener?
The analytical consensus gives us a bullish score of 7 out of 10. It's a compelling, albeit risky, opportunity. The intellectual property and insider-backed cash flows suggest it's undervalued relative to its potential.
So what's the play?
The proposed strategy is essentially twofold. In the immediate term, it's a swing trade heading into that March 30th earnings report, a one-month horizon to capitalize on the catalyst. But if the revenue numbers validate the tech, it has the clear potential to scale into a multi-year hold as those recurring revenues lock in.
It's a fascinating case study. It proves the future of AI isn't just about raw scale. There's an entirely parallel race happening right now for security, legal compliance, and walled-off applications that enterprises can actually trust.
That is the crucial shift. And for you listening, I want you to consider how this evolution in the AI sector impacts your own portfolio and your understanding of the tech landscape. We are moving away from novelty and into corporate liability. The rules fundamentally change when billions of dollars in fines are on the line.
It redefines what a successful AI company looks like.
It does. Which leaves me with this final thought for you to mull over. As artificial intelligence becomes completely ubiquitous in global business, will the most valuable tech companies of the next decade be the ones that know the most about the world, or the ones that are legally trusted to keep our most sensitive secrets behind closed doors?
That is a phenomenal question to end on. Thank you so much for joining us for this analysis. Keep asking questions, keep staying curious, and we will catch you next time as we continue to unpack the catalysts shaping your wealth. Have a great day.